in just 20 hours. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, this will outrage the incoming administration. I'll show you what's going to be announced tomorrow and why one high-ranking government official could be the first to be fired. And is one country on the verge of doing the unthinkable? I'll show you how their next move could trigger the biggest trade war in decades. Plus, we have a sponsor of today's show. I'd like to welcome Hillcrest Energy Technologies back. You can find them on the CSE under symbol HEAT and on the OTCQB under symbol HLRTF. And they just demonstrated their groundbreaking EV technology to Volkswagen, BMW, and Mercedes. And we're seeing a big potential move in their stock, one that could jump 28%. It's done this move once in the last 30 days. We'll show you why it's set up to make that move again. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where he picked today's story up as Fed Chair Powell's fate at Fed in focus after Trump wins election. And with the Fed meeting tomorrow and announcing their latest move on monetary policy, we know that President-elect Trump has been outspoken about his dislike for the Fed chair and the fact that the president does not have a decision in monetary policy. This could be shaking the entire global markets, because what the decision tomorrow not only could potentially lead to the very first firing of a Fed chair, but it has serious implications as global leaders all around the world are panicking right now. I'll show you why. Everything for Fed Chair Powell lies on his decision tomorrow, and yet it still may not be enough. As the dollar hits a one-year high as Trump clinches election victory. Now, we talked about this 2 days ago, how about the dollar could crash if Kamala Harris took the office. Obviously, that did not happen and sent the dollar soaring higher here, as many believe this is confidence in the U.S. economy. But there's a problem with a rising dollar, because this is not what President-elect Trump wants at all. In fact, it's not what the Fed wants or anybody in the global economy, which is why we're seeing right now global leaders panic as their currencies are plunging. This puts all eyes on Fed Chair Powell tomorrow in what could be one of his most critical decisions, one that could eventually lead to his firing, or one that could trigger an all-out currency crisis and possible global trade war. The greenback surged against all of its major counterparts as the rise in bond yields promised to pull cash into the U.S. And there's no doubt that that's going to happen, because U.S. yields right now are higher than they are anywhere else in the world. And that means if you're watching other central banks cut rates, investors are going to look for the highest yield they can get with the safety of the U.S. dollar. You're going to absolutely see money flow into the U.S., into the dollar, and into treasuries. There's no question that's going to happen. While Trump has advocated for a weaker dollar, investors believe that his policies will fan inflation and slow the pace of the Federal Reserve's rate cuts, ultimately boosting the greenback. And so you see the problem that Fed Chair Powell faces right now. The market is telling him inflation is going to come back in a big way due to President-elect Trump's policies, and now he's got a decision process, because we know President-elect Trump wants him to cut rates. We know that that's what he's going to demand, but yet the Fed chief has the issue that he's beholden to the inflation data as well. And so we see the challenge here, because not only are we facing inflation, an incoming president, but we're also facing a potential currency crisis as the dollar rallies and a lot of foreign currencies are getting eviscerated. This is a dangerous time for the Fed chief, as President-elect Trump has promised to cut taxes and slap large tariffs on imports, hurting the currencies of some of America's biggest trading partners. And based on just what we're seeing today, they're not just getting hurt, they're getting eviscerated. And this is forcing, of course, political leaders all around the world to panic. And they're on ice too right now, because they're watching the Fed to see what Jerome Powell does tomorrow, because his moves could make things better for them or could make it worse. Again, this is one time the Fed chief probably doesn't want to be on the hot seat, but everyone's watching him, and the big risk for him is he could be, again, the first Fed chief in history to be fired. I'd love to know what you think. Do you think Jerome Powell's in it for the rest of his term, or do you think as soon as President-elect Trump takes office that the first person to go is the Fed chief? Wait in the comments below. While you're there, check out Hillcrest Energy on the CSE under symbol HEAT, on the OTCQB under symbol HLRTF, because when we talk about a rising dollar, it is not inflationary, despite what the market suggests. When we look at the consumer price index in blue, shown on a year-over-year rate of change, against the nominal broad US dollar index in red, what we can see is periods where the dollar is rising and rising rapidly. Well, it turns out to be rather disinflationary, or as we saw in the global financial crisis, deflationary. We move forward to 2011, the dollar moved higher, inflation came down. We saw that again in late 2014 where the dollar surged, inflation came down. Then again around 2017 as the dollar took off, that brought inflation down with a lag. And then once again in late 2018 all the way through 2019. And today we see the dollar remaining rather elevated compared to its peers. And what do we see? Inflation coming down. So while the market is saying, wait a minute, we believe that his policies will be inflationary, a rising dollar suggests the exact opposite is going to happen. And the euro was the worst performer among the group of 10 currencies, down as much as 2.1%. on fears about trade tariffs hurting European growth, and that is absolutely true. We see the yen and Swiss franc were all weaker by at least 1%, and the Mexican peso was hit by 3.5%. And yes, if global trade grinds to a halt or slows down, what that means, of course, what we're going to see with global currencies is demand for them declines, and in a big way. That also means the safety trade turns into the dollar. The higher the dollar goes here, you force a liquidity crisis all over the world. This is a dangerous game. But something we think is also headed higher along with the dollar is a stock for our sponsor of today's show, Hillcrest Energy Technologies. You can find them on the CSE under symbol HEAT, on the OTCQB under symbol HLRTF. Let's take a look at their 30-day chart here, because you see the volume profile line, and underneath that line you see strong buying support come in. You see these last two moves where the stock dipped below the line, buyer stepped in, and then when it broke out it surged higher. We see that same move as the stock sitting right below its 30-day volume profile, and a move over that could send the stock surging as much as 28% in a matter of days. Again, stay tuned to the end of the show for more information. The U.S. currency's gains came on the back of a building bond market itself on the view that higher tariffs would stoke price pressures and lead to a less aggressive pace of rate cuts by the Federal Reserve. But that doesn't make any sense, because if the dollar's going higher, then it means imports are going to get cheaper. Even if you put a tariff on them and the dollar continues to roar higher, well, that means it won't make any difference. Demand for U.S. goods will plummet, and of course, Americans' purchasing power will go a lot less further than it does today. And of course, you don't get inflation with that combination. Trump's plan for tariffs and taxes should result in higher inflation and higher deficits, and that should mean higher long-end rates. This is from a portfolio manager at JP Morgan Investment Management, except the world doesn't actually work that way. Let's first talk about what's going on with inflation and why, if inflation goes higher, we're actually more likely to head into a recession. Because we go back and look at the consumer price index, now shown against total incomes, which is in the function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. What you can see is going back in time when there's periods of relatively high inflation, as we see here in the 80s and late 70s, and you see income growth slowing. Well, you don't get a continued rise in inflation. You see inflation come crumbling down. How about going into the 1990s recession? You see income growth slowing, inflation rising. Next thing you know, you're right in the middle of recession. You see somewhat similar happen in going into the dot-com bubble. A very clear example of that going into the global financial crisis, where income growth was slowing well ahead of the crisis as inflation surged higher. Now, the worst thing that could happen for Americans, as we see income growth continue to slow as inflation rears its head. It means, of course, American purchasing power would decline, their dollar wouldn't go as far, demand would plummet, and we'd be in an all-out recession. And that's the best case, if not a financial crisis. But the narrative here, or the belief that we would see higher yields because of higher deficits, well, there's no evidence of that. In fact, when we look at the federal surplus or deficit, and when the blue line is below the horizontal black line, it means we have increasing deficits. It means that rates are generally coming down, because when governments are running big deficits, they're crowding out the private economy. You see private economy grow slow, and next thing you know, interest rates tend to go down, not up, because it needs to spur growth and consumption. So the view here, at least from the Wall Street's perspective, why investors are reacting the way they're doing by driving interest rates higher, it's only going to be further damaging to our economy. The surging dollar has already prompted some authorities in Asia to intervene to prop up their currencies. The Bank of Indonesia says ready to step in, while state-owned banks in China sold large amounts of dollars onshore to help support the yuan. And you can see the beginning stages of a currency crisis forming here, because if the dollar continues to rally, it's going to upend a lot of these currencies tied to the dollar. It's going to force central banks and governments to react. They're going to have no choice but to sell dollars to prop up their currencies. And if that doesn't work, well, we'll show you why China may be forced with the ultimate decision. Let's take a look at the federal funds rate, because what the decision Powell has to make tomorrow has nothing to do with the demands of President-elect Trump, has everything to do with what's going on around the world. And if the belief is if the Fed cut rates, it causes the dollar to weaken, then he has no choice to do it, because right now he knows if the dollar continues to move higher, not only is inflation going to come crashing down, but U.S. jobs are going to get lost. Because again, you talk about this from an economic standpoint, what's going to happen is demand for U.S. goods around the world is going to plummet, jobs are going to be lost, and that means, of course, the Fed has to cut rates no matter what anybody says. Here you see the federal funds rate against the nominal broad U.S. dollar index. We know there's absolutely no relationship other than the fantasy relationship supported by Wall Street, but what it does do is it puts pressure on Fed Chair Powell to cut rates, because he knows that the possibility of tariffs could push the U.S. economy into recession. Higher dollar could push the U.S. economy into recession, or we could have an all-out currency crisis from multiple countries. Everything is around the dollar. All the pressure's on him, and if he doesn't do enough to turn the U.S. economy around, as I suggested, could be the first Fed chief in history to get fired. And U.S. bonds slide the most since pandemic as Trump renews inflation bet. But remember, this is an issue because the market's anticipating stronger growth and inflation. And that is correct from the standpoint that long-term interest rates are a function of growth and inflation expectations. But it has to come in that order. You have to get growth and then inflation. If you get inflation first and growth is lagging, well, as I showed you, what normally happens, consumers can't keep up with inflation, they spend less, and you end up in a recession. So what you're seeing is the market react to growth taking off, but the evidence with a continued decline in income growth is suggesting that's not like the outcome here. Because we go back in time and we look back in 2016 when President-elect then Trump was taking office, what was happening? The global economy was already starting a beginning phase of its upswing that happened before he took office, before he was elected president. This time, he's taking office as the global economy is in the early stages of a downturn. And bets on a resurgence in U.S. inflation were shown by the two-year inflation swap rates surging 20 basis points, the highest since April. The price action is parallel to the aftermath of the 2016 election when Trump's victory sent inflation expectations surging and bonds sliding. But again, it was not just about him taking office. That's what everyone's perception is. It was about the fact that I'm going to show you the global economy, including the U.S. economy, was in the early stages of recovery. The head of macroeconomics at T.S. Lombard said the biggest topic on our clients' minds whether self and bonds is just a taste of things to come. The answer is no, it's not. You're going to see interest rates reverse direction. And here's why. When we take a look at manufacturers' new orders of durable goods as shown in blue against 30-year treasury yields. Now, of course, the issue here is everybody from the top down has been saying, well, once election uncertainty is over, will the economy come roaring back? Will businesses start to spend? Will consumers start to spend? And consumers aren't going to spend as long as their income growth continues to slow. But look at this. We talk about the difference between 2015 and now. You see here the manufacturers' durable goods had bottomed out and were already starting to move higher. This was around mid-2015. Interest rates continued a downward move and then started to rise. It didn't matter that President Trump then was in his first term. What matters now is you see that manufacturers' new orders are going the opposite direction. When that happens, we go back in history and see that it coincides with a decline in yields. So looking at T.S. Lombard's big question of their clients, the answer is, as long as the economy continues to slow, any move higher by investors or Wall Street in terms of the bond market and driving yields higher indicates that it could be a big buying opportunity, because as long as the economy slows, interest rates have to fall. And if the market keeps them elevated, well, all they're going to do is make the next crisis even worse. And we look at demand, we don't find it in the oil markets, at least not this week. The Department of Energy reported builds across crude, Cushing, gasoline, and a big build in distillates at 2.95 million. But how about we look at the mortgage market, because that was already grinding to a halt. And now Wall Street says, look, growth and inflation is going to take off. But if rates of course, a week ago were already too high and already causing a big slowdown in the housing market, well, higher interest rates aren't going to make any difference. In fact, it's going to make things worse as U.S. mortgage rates rise again, now with recent jump the most in 2 years. And the Mortgage Bankers Association gauge of refinancing dropped for a 6th straight week to the lowest since May, marking the longest losing streak since April 2022. The purchase index declined since the lowest since August, suggesting the housing market is going to continue to grind to a halt unless interest rates come down. But as we started the show out, is one country, could China trigger an all-out trade war? Well, there's one move they may be forced to make. If Powell doesn't come to the rescue and start to take pressure off the dollar, well, we'll see, as China could then trigger what I could see is the biggest trade war in decades. As President Xi is better prepared for Trump, even a 60% tariffs risk chaos. Well, if the dollar keeps on a tear, the 60% tariffs won't be that bad. But if Trump follows through with his tariff threats, Chinese authorities will need to do much more to help the economy. Goldman Sachs said last week that steeper trade restrictions on China may force Xi's hand to bolster domestic consumption, something the Communist Party has traditionally sought to avoid. But the issue is they can't do it, because if the yuan is tumbling and they do stimulus, the market's reaction is they're going to weaken the currency even more. We know that governments do not like to do that, particularly China's case, where they're trying to get their trading partners to use the yuan. But if it keeps declining in value, other trading partners are going to turn to the dollar or other currencies. They're not going to want to use it. And that could force, of course, China to do the unthinkable. And that means giving investors a taste of the volatility that lies ahead. And this is dangerous because China can hardly retaliate on the 60% tariffs. They just don't have enough demand domestically. They can't do further stimulus, even though the belief is they will, but that will send the yuan tumbling. A renewed trade war threatens to do greater damage as Chinese companies exported $500 billion in goods to the U.S. alone, or about 15% of the value of all exports. If the U.S. were to put high tariffs on all or much of those products, it could wipe out those sales and further hurt firms facing a weak domestic economy and falling prices, which would mean they would be forced to do the absolute unthinkable, which is devalue their currency. And if you want to see President-elect Trump get absolutely outraged during his first term, well, I can tell you, if China devalues their currency, you're going to see the biggest trade war in decades erupt, and it's going to be massive. But from China's perspective, they'll need to do anything to keep their economy and running, and that means making sure their exports are cheaper no matter what we see from Trump's next administration in terms of tariffs. But something we believe is also going to take off is the stock for our sponsor for today's show, Hillcrest Energy Technology. You can find them on the CSE under symbol HEAT and on the OTCQB under symbol HLRTF. We're going to take a look again at that potential 28% move, but let's look at what Hillcrest is up to. All the information in the pinned comment and description below, because they're developing electric power conversion technologies tailored to the next generation of e-mobility powertrains and grid-connected power systems. And Hillcrest's zero-voltage switching technology is a unique approach to soft switching that combines proprietary power electronics hardware and firmware to deliver next-generation benefits in electric systems. And their first product is an EV traction inverter, offering new levels of efficiency, performance, and reliability not yet available in conventional inverters on the market today. And that's why they're excited to announce they're advancing toward commercial agreements and expanding their European demonstration efforts. Hillcrest is advancing joint development discussions with leading automakers and Tier 1 suppliers such as Volkswagen, BMW, and Mercedes, fueled by growing interest in zero-voltage switching technology. Our ZVS traction inverter and power factor correction prototype stand out for their unique benefits such as enhanced efficiency, elimination of switching losses, and superior electromagnetic compatibility. These advantages make Hillcrest technology particularly appealing in the electric vehicle and industrial power conversion markets. We believe we're on the verge of a major breakthrough with our first commercial agreement potentially nearing fruition. Several potential deals are in the advanced stages, and our recent demonstrations and strategic collaborations, especially in Europe, paving the way for a formal partnership. We're confident these ongoing discussions will soon translate into significant commercial transaction, driving long-term growth for Hillcrest. And the reason we believe this technology is going to be in such demand is ZVS's traction inverter, which offers potential savings up to $2,200 per vehicle. It strategically positions the company to capture a substantial share of this expanding market, one that we know is not going away. But talk about expanding opportunity here. We think this could expand your trading account in a big way. Let's take a look at that 30-day chart again, because you see the 30-day volume profile here. Below that is where the buyers are at. You can see every time the price comes down, buyers step in to support the stock. You see it happening once again here now for the third time, and we believe a sustained break above that 30-day volume profile can make a very quick move up by 28%. You see it coming out of that second bottom here. The stock just shot up days after, and that realized about a 28% move above the volume profile line. Again, you can find them on the CSE under symbol HEAT and on the OTCQB under symbol HLRTF. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.